Here at Longines Capital, we've spent over a decade building a strong track record with our full suite of services and high performing funds. Now we're setting our sights on something even bigger, an IPO in November 2027. It's been a long time coming, and we are ready for the journey. Join us in our next big step. Visit our website to learn more. Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Longines Investor Insights. Join us as we dissect the biggest and most interesting news on economies, financial markets, and central banks globally. Welcome to the show. Hi, Peter. Happy December. How are you doing?
Hi, Mel. I'm doing good, and it is really, really busy. So, and that's only good. Busy with a lot of good things, as we are predominantly because we're getting closer to year end now. So we have 2.5 weeks to do all kind of things and getting that settled. The office is officially closed, but for investors and clients, we have open every day from 8 to 8, also
Yes.
Christmas Day. So that never changes. But anyway, it's busy. We're doing a lot in our defense fund right now. We have during the past months prepared 4 new investments allocations, and they will all be executed during December. We have just made 2 investments this week, and we will announce them the coming 2 weeks. Explain a bit what we are doing. It is
Mm-hmm.
also always this very fascinating high-end technology, uh, and really, really fascinating. So that's good. We have more inflows in the fund also, and then we are getting close to where it really counts when we're doing the the assessment of the funds and the fair value pricing, and see
Yes.
where we have the funds and if we have earned some money for our investors this year.
Yes.
Um, and I can disclose we have.
That's great.
So
Always great
that's
to
good.
hear
Yeah.
that,
So a
Peter.
lot of things are going on. Of course, also a bit of end of year on the social part, where we are seeing some good clients and investors, and um, showing our thankfulness for the business we've seen. So we've been on the road, and that is always a very good part of yeah, of December, of course.
Mhm.
So a lot of things. Mel, what about you?
Here, Peter, we also are wrapping up several writing projects at once. We can think of it as like holiday reading for investors, for our stakeholders. So,
Yeah.
a new magazine's very, very soon, and at least another one on the way for the
Yes.
rest of December. So, maybe that'll keep everyone updated and as they relax over the season. And that's very exciting as well. Insights from all over the world, thanks to our contributors who are on the ground, and also, of course, which assist us in our investment decisions, Peter.
Yeah, yeah, yeah. I'm looking forward to the new 2 new coming magazines. And there will be something to consider over the, as you say, over the holiday season. So that's good, Mel.
Yes. Actually, speaking of international insights, Peter, we do have a few topics on deck for today. It's episode 62 of Sound Economies. And first, we'll be here in Asia and looking at China's um, exports of gasoline powered cars, which is apparently still much of a bigger deal than the new energy or electric vehicle. So we'll look into that. And then
Hmm.
we'll head to India as a very hot destination for public listings. We'll look at why it is such this year. Then we'll do a sort of side by side view on the Japanese and American markets, especially as we head into the last few weeks of the trading year
Yeah.
2025. We'll also look at year end movements in general and what's in store for investors and the financial markets coming into the first working day of 2026. And as
Yeah.
usual, we'll do our global outlook, Peter.
Um,
So let me start with the discussion on the Chinese automakers.
yeah,
I think it's been quite a favorite topic globally. Well, at least I can say for this podcast as well that we've been so excited with the electric vehicle market and how Chinese automakers are seemingly on track to dominate the EV trade globally, especially when they outpaced the likes of Tesla. But still, we see that 76% of their car exports remain to be gasoline cars. And the main reason, it's very interesting, um, since the CCP, so the Communist Party, introduced really an assortment of policies that would steer households, Chinese households, and Chinese businesses towards these electric vehicles in the mainland. What are these automakers gonna do with their or their excess supply of gas or diesel cars? And their
yeah,
solution is to sell them abroad. So the sweet spot that they have found is to send them to mid-tier markets. So when you say mid-tier, you have some sizable amount of or number of middle income households with disposable income who can afford cars, but not the high-end ones. So maybe not European cars, not
mhm,
American cars. They need cars, but these are also locations where electric vehicle infrastructure is not yet as abundant or none at all. So they've
yeah,
found Latin America, parts of Eastern Europe, and Africa, particularly South Africa, Poland, and
mhm,
Uruguay, these countries in particular, as their hot markets for China-made gasoline cars. So it's very unique. What happened here is automakers were highly productive in China.
mhm,
They had been churning out a lot of cars to sell locally. And then the EV policy pivot
yeah,
was introduced. It came with subsidies. So households were actually incentivized to trade in their old gas cars. In
mhm,
exchange, they get a subsidy to buy brand new electric vehicles for sustainability. So now there's this abundance of gasoline
mhm,
cars that won't be sold locally. So they pivot elsewhere, and it's also very strategic that China has opened warmer, larger trade ties with Latin America, for example. So now it's even easier to sell there. And I think
yeah,
what we can see here is how impactful the industrial policy of China is, not just domestically. The pivot was quite quick. I guess, of course, it's running differently than other governments, so people are
mhm,
quicker to follow the lead. And now, we know that there's been a price war on vehicles inside China. It's
yeah,
looking like it's going global because Chinese cars, very cheap Chinese cars, are being sold
yeah,
abroad. And yeah, it is a very interesting development. And the forecast actually is that in 2020, for example, 1 million gasoline cars were sold from China abroad.
mhm,
The forecast is 5 years later, this year, 2025, it will be at 6.5 million. So that's the scale, Peter, really.
yeah,
And
yeah.
it is growing fast. So side by side with like electric vehicle sales,
Yeah.
China is really on track to dominate that space.
It is first of all, of course, interesting, and it's sort of an ongoing reminder for investors how the market actually is moving fast.
Mm-hmm.
But if we look and combine it or yeah, combine it with one of our mega trends, where we argue heavily, is that the global middle class is still growing and it will continue to grow. Now, that is in particular due to growth in the emerging market countries, as a meaning that it's the middle class in
Mm-hmm.
the emerging market countries will continue to grow. Also, as long as we can see, uh, as a small addition, we should say yes, the lower middle class in US is also growing. It is unfortunately because people are dropping out of the upper middle class and are
Right.
uh, earning less money. So that's another story. But The key is the Chinese car producers and the automotive sector is fantastic positioned, is that they can produce a car that can be bought by the upcoming middle class in the emerging markets. Because when we are talking about a middle class household in emerging markets, we should remember it's in local currency, meaning in absolute terms, they do not have the same purchasing power as a middle class income in Europe.
Right.
But in local currencies, and then we are talking about in as a PPP, the power parity purchase comparison, and that means that in local currency, people have just as much purchasing power
Right.
as a European middle class would have. And there, in particular for these households, the Chinese cars are completely right priced, and the outlook is simply that the steep rise you have described will continue. So investors, they can still jump on the wagon, is basically what we're saying.
Right, Peter. And actually, a lot of Chinese made cars are actually carrying brands that are known globally. So, like
Yeah,
Volvo, for example, we think it's still a European made car,
Swedish
but
car.
it is or American, yeah, but it's
Yeah,
actually China owned right now.
yeah, yeah,
Geely, MG, it's no longer British, but they still they're still gonna buy it because it's familiar, but it's not
yeah.
necessarily the same. Yeah.
Yeah, fascinating story, and that will for sure continue in 2026 if we are trying to look into into the new year next year. Good.
Yeah, Peter. So we can head over to India, and we
Mhm.
also see uh, a very encouraging trend as far as the stock market is concerned. So
Yeah.
the Sensex, so that's the Bombay Stock Exchange, is seeing a record number of initial public offerings this year. And
Mhm.
for December alone, they're expecting 25 listing debuts in the market.
Yeah.
Um, they're so far into the year, they have 221 public listings. That's for both the main board and the SME or the Small Businesses Index,
Yeah.
coming from 158 last year. So everything seems to be aligning for India, at least for the second half of 2025.
Mm.
US tariffs aside, they had a very strong GDP number of 8.2% for the third quarter of the year. Very low inflation at 0.25% in October.
Yeah. Yeah.
Rapid growth in or expansion in manufacturing as well as services PMIs, and also ample liquidity onshore. So
Mm.
it looks like the ideal scenario for companies to go public, especially for a market for those serving a market as huge as India. So the consumer market there is very very big. Of course, it's more than a billion
Mm.
people,
Yeah.
but at the same time, they're also well into the tech industry and
Mhm.
global services as well. So confidence is really there. Earlier into the year, it's not been as rapid or as robust, but with the
Mm.
listing of big names like LG, so that's the electronics maker, and Tata, so diversified group,
Yeah.
the momentum has really been going up, and the drive is internal. There's really been a strong pickup in
Mhm.
domestic activity in terms of equity investments, and although we did see, Peter, that the stock exchange isn't it's up year to date 9%, but that's
Yeah.
slower
Yeah.
than other major indices. So for example, in the US, they're up like 16,
Mm.
20%.
Mm. Mm. Mm.
Their neighbors Hang Seng is up 29%.
Yeah.
Yeah, there has been some slowdown. I think we can really see that that was the impact of the initial no deal scenario
Mm.
with the US. But coming from the very strong macro data in the third
Mm.
quarter onwards, there's really been really fast takeoff as far as optimism towards the Indian market. And I think that's what's gonna continue coming into 2026. A
Yeah.
rebound is bound to come, Peter.
Yeah, and should we be fair to India or the Indian stock market, however we want to express it, is that they truly had some very strong gains basically ahead of the rest of the world for like 1.5, 2 years, 2.5 years
Mhm.
ago. And that was partially the very strong domestic case. That was the key. This year they have been squeezed a bit by Trump and the very high tariffs, about 50%. Now there's one case, and that is that might be an interesting concern that India is fantastic, well known for its IT capabilities, and it's an IT destination in many
Mhm.
ways, and they have magnificent universities. They are extremely impressive when we're coming into to IT, but they have lost out to China. And the sort of where they lose out is actually the AI capabilities, the AI dominance, where China is way ahead. And that is, of course, a also for next year, but also for the next decade. It can be an outperforming factor, to put it this way. Yeah. But that is the weak spot when we're looking into to India compared to a big competitor, China. But otherwise, India is still a strong case. It's a very domestic strong case, and we can only conclude they have done everything possible to fulfill our dream from start of this year about a lot of IPOs.
Yes.
So they did well, and applause for that from Longrange. Yeah. So that we like. Also, it looks strong also when we're looking ahead. Yeah, for sure.
Right, Peter. So actually, for India, there is more room to like grow the market,
Mhm.
at least as individuals, investors, with the successive tax cuts for income earners. So we can also expect some impact there, maybe going into 2026, since the latest cuts took effect just a few weeks ago. So that impact could, provide some more push heading into next year. But yeah, otherwise, it is a great story to hear at a time when we're not so upbeat elsewhere.
Let's take a slightly different view
Mm-hmm.
for a couple of themes. And yeah, we talked about we are getting closer to year end. Does it mean anything at all? Yeah. What's cooking? Could we see some effects? And of course, we need to start to look into 2026. What can we expect? And so, yeah. And now we are. Maybe we should mention that we are focusing about large economies today, and people will notice we don't have any themes about Europe, basically, because we are focusing on also a bit year end and then looking into next year, where most could be cooking. Our frequent listeners, they will know that we would like a lot more to be cooking in Europe, but nothing is cooking. Just on the note, as we just want to mark that we are aware that tomorrow, on the 5th of December in Germany, there
Mm-hmm.
is a very important vote in the parliament about what they call retirement reform.
Yes.
In our view, it has nothing to do with a reform, but nonetheless, the vote is there, and that is fantastic important because um, the government is still unsure if they have majority for their own proposal because there is a fraction of the conservative, it's the young fraction, they have marked against this so-called reform, but most of them will probably vote for and say yes, not to throw German out in a new government crisis because this is actually all of a sudden a milestone cabinet question. So we are fully aware of that, but we are looking at the areas where things are cooking, and
Yes.
that is, of course, because it's the most exciting, but it's also where investors are sort of in demand to have considerations and take decisions. So yeah, Mel, what's cooking?
Well, actually, it's been quite a theme as well for the past few episodes, Peter. We've really been interested with, of course, the US being the largest economy of the world, but
Yeah,
also very recently Japan. It's a tale
exactly.
of diverging development, so to speak. The US, a lot of eyes on the Fed, for example, to really cut the interest rates to hopefully stoke some growth, help out
Mm, mm,
businesses to get back into a hiring spree after yet another negative figure for jobs in the private sector um, for November.
Yeah.
On the other hand, we see Japan raring to raise interest rates this time to contain some of that elevated inflation and also make it a bit more attractive to save, so to speak, or raise the interest rates a bit more. So a lot of action there. Taking Japan, new prime minister trying to perk up the economy with $136 billion in a mega stimulus program, combining tax cuts and household subsidies. They're trying to help households which are a bit caught in the higher living cost scenario. So
Yeah.
we'll see more of the effect of this stimulus maybe heading into 2026 more than the 2025 because it's just a few weeks left, and of course it will still
Yeah.
be rolled out and distributed, which I imagine will be quicker than elsewhere. uh, of course their efficiency is known, but yeah, that is one major factor that we are watching out
Yeah.
for and how it
Yeah.
can really push activity in Japan.
What we are discussing is if the new prime minister, she will rattle the market, or will she actually generate more optimism by, you could say, the expansive initiatives. And you have covered in earlier podcasts that she's actually sort of a favor of Abenomics. That was for people who remember back. That was sort of the market was very split. People were very split about his economic plans reform, but he actually did a lot of things, and he actually moved Japan onwards.
Forward.
And net, it was probably okay for the economy. Yeah. The key is you can never repeat just
Yes,
doing copy
times
paste
are
because
different.
the world has simply changed since then. Right now, we trust this would lead to some optimism somehow domestically in Japan. What's going on right now, and what's all the reform work and expansion, economic expansion. We know that the fiscal year in Japan ends on the 31st of March, but
Of March, yes.
still, the majority of investors in the world, they work and think in the calendar year. Yeah.
Yes.
So we go into 2026 looking at Japan with a sort of with some optimism, saying, okay, so we go there
Mm-hmm.
and trust in the sunshine. Yeah, that's basically our current conclusion. But we will again also when it comes to Japan and in general financial markets, it looks like more volatility next year. Also, it will not be easier to be an investor. Let's put it this way. And uncertainties will probably jump a bit faster and come more often. As you mentioned, we will also, of course, look a bit in US. It is the biggest economy in the world, and that is for sure where there are something to discuss, and we expect higher volatility and higher uncertainty next year.
Yeah.
Trump, he's under pressure.
Yes.
He's under pressure from all sides, whatever you look at, and he's caught. He's caught in reality, basically. That happens for a lot of
Mm-hmm.
government leaders across the world. All of a sudden, what they have planned might be good, but the world is just bigger. And reality is reality, and that is the biggest force in the world.
Yes.
So Trump, he is caught in reality also. First of all, his plans, not plans, that was just to create a havoc, also domestically in the American economy, that we have criticized for almost a year now. So no need to repeat ourselves there. But he is caught more in foreign policy that he wants to be. And we know, also mentioned last time, the American voters do not honor that. And the worst thing is that people are squeezed in US now. The households are squeezed, and that is exactly as expected. And even we discussed it last week, but just within this week, what do we see? What do we see as discussion point? How do we see market reactions? Just within this 1 week, there is more, as we see it, evidence of the market reacting towards all the negative complications of, let's call it the Trump economic policy, or whatever we want to call it. It is a value destruction what has been going on, and now we are getting so close to 2026. The midterm election speculation will emerge faster than we thought for just 1 week ago.
Oh, yes.
1 week ago, we started discussing, okay, when will the midterm election start to have an impact on our minds? And we say, okay, yes, we all know it comes, and we all know
Mhm.
how the pollings are about Trump. And we say, okay, maybe end of March, sort of late Q1. But there's a big risk that this will actually be one of the biggest factors when we sort of open up for 2026. In the markets, if we should look at very focused
Mhm.
events that could happen, we are seeing again a bit more fatigue in the tech sector, AI sector. Exactly as after all how we predicted, prepare the portfolio a bit for sort of a downwards correction. That we of course keep that recommendation, and we could see a bit sort of tech AI sell-off. It's very hard to imagine that should be any strong positive stories out the rest of this year
To lift it, yeah.
when it comes to tech and AI, unless there's sort of a completely unexpected at the government level decisions or maneuver. Yeah. So we could see it drift a bit, and that ends up when we sort of say, okay, so how was the year? How was the U.S. stock market? Okay on the headline for some, particular American investors. Currently, as you mentioned, the S&P is up 15% this year. That's okay, but if we look a bit broader and take the Russell's 2000, today it's up, or yesterday it was up sort of 12%, yeah. But it's only because it's performed well the past 14 days. 2 weeks ago, it
Yeah.
was almost back to where it started this year, so it was very close to zero again. So it is predominantly, as we know it, tech AI sectors taking the stock market a bit up.
Yeah.
But from the rest of the world investing into US this year, a zero-sum game, the dollar has lost 12 to 13% against the euro. So for European investors who are not hedging their portfolio for currency risk, this year has been zero or small minus when they look into the US stock portfolio. And the US stocks are, after all, for natural reasons, taking up a pretty okay part of a stock portfolio. Yeah, it's not that fantastic when we look into US, and this is actually what is we have to start up when we
Mhm.
look into 2026. Yeah, so there could easily be nervousness if for non US investors the result was not fantastic good. And then they look into 2026 where volatility will increase. It will increase, and it will be more difficult as to be an investor. We need to work harder to earn our money next year, and that is also okay. It's what we paid for, so we shouldn't be
Saying good
afraid.
advice.
We tried that many times the past 40 years, so that's okay. But that is this is the outlook. It's what we're looking into. So it could be one of the years where the first 14 days actually are pretty negative in the stock market. But then we will say if that should happen, then it could easily be the place time to buy.
Yes.
We're not afraid. But there'll be all these kinds of thinking speculations. And if we look in again next year, midterm elections, what can Trump do? He needs to buy the voters. He needs to buy the households. Meaning there's only one way, and that is to do something about tax, income tax, whatever, hand out money, do something, but it will cost money and it will cost on the US government budget deficit.
Mhm.
It will be even bigger, and that will be a big thing next year. And rating agencies, they'll be there and saying, warning, warning. And we know that higher budget deficits, government budget deficits, is not in favor among investors. Just within the past week, we have become more skeptical about also sort of the returns on assets in US next year. But this is certainly something we'll revert to, maybe also during December, and for sure in the start of January. So yeah, slightly a bit more sort of cloudy outlook, but anyway,
Of course, Definitely, it would not be the best to hear that 2026 will be a tougher year for investing. But at the same
Mm,
time, as you said,
mm,
one can just choose to buy the dip, so to speak. If it happens in the first 2 weeks of the year, then so be it. Be ready. At least we've given enough time to warn them. But otherwise, Peter, despite the more, the cloudier outlook that we have, we still see that, of course, it is not the best route to pull out of of the stock markets, of the global financial markets altogether. It's all about considering where to take positions. And as we always advise here, we are more optimistic towards the emerging markets, of course, particularly in Asia, in Southeast Asia and China. So that's where we are remain overweight. And yeah, well considered risks are the way to go for the next year coming into it.
yeah. We still see upside in the world, and there are truckloads of opportunities. We have discussed different strategic adjustments throughout 2025 and here in our podcast, and this is exactly the same we discuss with our clients. That should be it's there's no difference, and we're happy to share the insight, and we're also happy to hear reactions. That is almost the most interesting to see what other people are thinking. We are indicating one sort of increased thinking at some time, maybe during the holiday season coming up, is how to deal with US next year, as a how to deal with US investments, the US risk, fixed income, corporate credit there, and also the stock markets, the greenback, the US dollar. It is the biggest part in positions around the world. It is the biggest economy in the world. And to get that one right is just so important. So that is getting higher on our agenda, how to deal with US investments in 2026. That's probably it, yeah, for today. A bit extended, but important.
That's our assignment, Peter, to keep figuring that out. But otherwise, that's all we have for today. Thank you, Peter, for sharing your valuable insights. And as always, thank you to our listeners for tuning in. Thanks for tuning in. We'll be on the lookout for market developments worth watching. Catch the next episode of Sound Economies, Mel and Peter on the global financial markets, available on our website and on Spotify. For expert insights on the go, download the Lundin's Investor Insights app for free. Risk loving investors will find opportunities in our high quality alternative investment funds, especially our multi awarded Mutual China Fund. For more, visit lundinscapital.com.